Okay, so there we go. So part two, volume, action, price action and behavior. So we've talked about a little bit about the behavior. We're just going to go into a little bit more depth now and really look at a few chart patterns, candlestick patterns, volume, put it all together so you can understand what's going on. Okay. So first of all, volume. So let's go through this. So I'm going to, a simplistic view of volume is like throwing a pebble at a glass window, okay? Toughened glass, slightly toughened glass, okay? Throw one small pebble at a glass window and probably it won't smash, okay? So imagine that this glass window on the left there is a price point. If a few institutional traders throw a small pebble at it, it ain't going to go up, okay? Or shoot retail traders. So if you place an order of 100 shares of the stock at the current price, you know, the stock may not move at all. And that's when you get that swapping, yeah? Okay, so then more people get involved, that herd mentality starts coming in, okay? So if 10 investors sort of place orders at different sizes, but there's more momentum and more people wanting to shove that price up and that volume, at some stage we break through and the brokers, nobody wants to sell at this price anymore, okay? There's loads more volume in, somebody's gonna say, oh, I'm hanging on. I can get another 50 cents on this one, I'll hang on. So, but at some stage, the broker's got to put the price up. And that's when you get that increase. That's how volume, it's a simplistic view of volume, but that's what it is. You throw a pebble at a glass window, just one pebble, it won't break. You start throwing lots of different size pebbles at it, at some stage, it will break. And that's what volume is. So there's not enough sellers. So what happens? The broker has to put the price up. So someone's interested in selling their shares because there's only a set amount of shares. They have to keep changing hands. And somebody has to be interested in selling those shares. Okay, average daily volume. Mathematicians among you? Okay, look at that. It's a load of crap. Okay, you don't need to use it. Don't overcomplicate, keep it simple. Again, best line of fit. I don't know what you call it in the US, line of best fit, whatever. Can you tell me roughly where the line is? Can you visualize it in your head where the average daily volume is there? Just visualize it right now, okay? That's my line of best fit. Yours might be slightly higher. Okay, but I'm conservative, okay? I'm English. So forget all of this crap and people trying to teach you all these equations and all that sort of stuff. Just look at it, okay? If you've got one of those really big spikes, it's above the daily volume, the average of the daily volume. If it's below it, it's low volume. Don't spend half an hour trying to work out something that makes absolutely no difference to your trading. So, seriously though, if you know the total volume on a day, you can understand the power of the influence. So on those really big days, there's a lot of influence. So those green volume bars, there's a lot of influence to buy, okay? So green is bullish, it closes higher than the open, okay? Red, it closes lower. On an up day, yeah? On a down day, when it closes lower than the open, the volume's red, yeah? Now, I want to introduce the term accumulation day. So an accumulation day is a bullish day, but it has an increased volume from the day before, okay? A distribution day is where we're distributing shares, we're selling shares. So it's a down day, but the volume is greater than the previous day. So momentum's building up. We're going to go through this a little bit more. So again, there's no need for fancy formulas. What we want to concentrate on is accumulation days. So we want to see increase in volume to the upside, or distribution days, increase in volume to the downside. This is why we use red and green. Okay, volume accumulation days, volume distribution days, and then we're going to then sort of finish off with volume during wave 3, wave 4, wave 5. Because again, it's understanding that pattern that's forming in the markets and that herd mentality. And then we're going to do volume during trade management. Because once you're in a trade, you've got to find some way and some indicators, if you like, to understand what's going off while you're in the trade, how you're going to make a decision. How's the market behaving in this move that you're in? Because at some, you know, you might see certain volume and price action behavior and think, you know what, I'm going to take profit, I'm going to get out here because I can't shift the market, something's going off, I'm going to get out, you know. So it's understanding that as well. So accumulation day is where people amass, accumulate shares, they're buying, yeah? The broker can't find any more sellers, so they're putting the price up and people are buying more shares, they want to get it, yeah? So if a stock has, let's just put that next bit on there. So if it has sort of 2 or more accumulation days, we can say, you know, it's looking pretty strong or bullish, okay? So we see that first green volume bar there. The next day, it has more volume, okay? And it's green, so it's up. That's an accumulation day. The next day, slightly even, okay? It's not really an accumulation day. The next day, we've got increased volume. People are amassing and buying more shares. And the broker's putting the price up, and the want and the need is there. Then it's going higher. That's a good sign of bullish momentum, okay? A really good sign of bullish momentum. You're getting those accumulation days. Some days you get a little rest day. This could have been a Friday. I don't trade Fridays. You know, if you're swing trading, you're not going to put a trade on a Friday. Even if you're an institutional trader, you're not necessarily going to make that decision on a Friday because Mr. Trump meets Mr. Z on Saturday and the whole bloody world falls apart, okay? Don't trade on a Friday. Go to the zoo. That's institutional traders gambling. That it will go up on the Monday. There will be a gap. So if you've got a run into Friday and you've got a bit of momentum going, why not buy a little bit lower and hope that on Monday there'll be some good pre-market action and it'll gap up. And usually Fridays and Mondays will update, update. Yeah. Tuesdays were kind of flat. Wednesdays were down days. Thursdays were flat. Fridays were up. Right. That's what I was trading for a long time. On futures. Yeah. Yeah. With a stock, it's slightly different. You know, you're gonna. I look at the whole market all the time. So I've got 9 screens. Yeah. So I've got 9 screens, and on my left, I'm sitting on my desk here. On my left screen is NQ and ES. Okay, on the 5-minute chart. But at the beginning of the week, I take them to 60-minute charts and I put all the linear support and resistance zones in that's going to be important for that price level for the week. So while I'm trading stocks, day trading or swing trading or making decisions, I'm seeing how those futures markets are reacting. And those will help me make those decisions for day trading especially. And we'll see, it's because there's certain levels on ES that I pick out that are important. And if it refuses to push through there, you know, this bullish, it might be a slight bullish momentum that day, but if it refuses to push through that ceiling, you know, the stock market itself is going to suffer because, you know, there's not enough buying of stocks, there's not enough accumulation days to keep it, push it through that 2,800, for example. You know, so there's certain, I always keep that, you know, we always say look left on a chart. I always look left at the futures chart because I'm always conscious of what's going on there. So volume distribution. Now, this is a bit counterintuitive because you're getting lower lows and lower highs price action wise, but you're getting these sort of higher sort of volume bars, if you like. So it's a little bit counterintuitive, but you just need to think that if it's a red, and on Think or Swim, for example, you could set all them to be blue, but that's pointless. You need to see if it's a down day or an up day and what the volume's like. So if we've got consecutive down days, so lower lows, lower highs price action, but you get an increase in volume, these are distribution days. These are people getting rid. Okay, this is brokers. Someone's trying to sell something and no one wants to buy it. Okay, so you've got to put the price down. No one still wants to buy it. Put the price down even more. Everybody dumps a load of stock. And that's when you get these big moves, okay? Yeah, that's that herd mentality. And you see the difference between those accumulation days and these distribution days. Look at the difference in volume each day. And that's, you can make your moves down go faster than your moves up. That's how the markets move. And you can just see that with this volume here. So again, this could have been a Friday. Most days on a stock on a Friday is low volume. Everybody wants to get out of the city early. Yeah, Friday is low volume. So, but it picks up straight away again. I mean, that is huge. So let's go on to volume during a wave 3. Because we said accumulation, distribution. Now, this takes a bit of practice, and we are recording, but you need to understand how a wave 3 moves, and I'd split it into 3 different sections, okay? And yes, you've got the price action, but this is why I'm doing volume on its own right now, because you need to, hopefully, over time, start to understand how that volume reacts. So, we've got phase 1, okay? So you've got greater collection of accumulation days in phase 1, yeah? And they're quite big moves. So it's that big initial, you've been burning rubber, you let go of the handbrake and you're gone, yeah? And it's that big move up. There's that big sort of desire to buy the stock and it drives the price up. Okay. So you can see there, can you see that? Oh, it's off the chart, it's off the screen there. Okay. So there's one off to the left on here, but it's not shown on the TV screen. I don't know what it's showing online. Yeah. So you've got sort of 3 sets of accumulation days there. You'll see the red volume days, they're not distribution. You've got 1 distribution day on the first red line, but then it doesn't follow on, it's lower volume, okay? That's just a bit of profit taking that day, but there's no interest. You've got a collection of more accumulation days than you have distribution days. So that's your initial push. Okay, then you've got the second phase. Now, runs out of juice a bit, it's not quite wave 4. So, you've got to, the average daily volume drops. You don't need a big formula to work that out, okay? Look at the average daily volume in the first section and then compare it to the second section. It's a lot lower. You just need to see it by eye. Okay, so, right, so there is a little pullback. You see the initial distribution days there. I'm sure I've done these with ellipses, yeah. Okay, so these initial distribution days are quite high. So this is a catalyst for a slight bit of profit taking, okay? So wave 3 is never a one straight line up. There's always somebody that wants to take a bit of profit. And if that, that herd mentality continues, it keeps going down. But in a wave 3, that fizzles out quite quickly. So then you get some, we got, what is it? You got a couple of days there, accumulation days. And then the volume really starts to peter off. Okay, so what you've got is, you've got bullish and bearish days, the average volume starting to pull down in the middle. There's no real sort of distribution or accumulation. It's just all over the place. People are trying to decide if there's enough want and need to push this price up. And then somebody says, I actually think this is good value. And there's a small, in this last ellipse here, there's a small accumulation day and then two massive accumulation days, and the momentum starts again. Okay. Now, I don't know what happened during this small phase of volume there. It could have been a short trading week because of Thanksgiving. There's lots of other instances in the markets and everything else which cause that. It might have been earnings. Okay. It might have gone through an earnings cycle on wave 3. And leading into earnings, there's lower volume. I'm not taking the risk. I'm not buying. I'm just going to sell a bit, you know, and it's that lack of sort of risk appetite. And then all of a sudden earnings come out. What happens? Boom. Yeah. Great earnings, gone. Yeah. And the wave 3 continues. Okay. So the final phase. So we do see, right. I'm not going to say anything. What can you tell me about the average daily volume on the third phase of wave 3? It's higher. Yeah. Look at the average of all those daily volumes. It's higher than phase 2. It's the run into the end. Yeah. They've just done a 5K run. They've saved a bit of energy for the end, and they're going to go for it. They're going to push for home. Yeah. So, you know, and it will fizzle out at some stage. And you can see overall, you can see the peaks of the volume coming down. So it's running out of juice, as I call it. Okay. So you're getting, let me just press the button. So we've got that big push at the end of phase 2, and we get a slight pause, but then it continues again straight away, but with greater average daily volume overall. So the momentum's still going. We get some great days there, some great accumulation days, really, really good. But then we get that first sort of big distribution day. So, you know, at that stage, it's just a one-day wonder. We don't know what's going to happen. But then look at the volume after that, how it starts to peter out on average. Even those accumulation days aren't as big as that distribution day in volume. So at some stage, we're running out of juice. We don't know when it is, but it is running out of juice. Okay, so that's a wave 3. Again, it's recorded. So let me just check it's recording. Actually, now I just said that. I'm not one of those that goes out the door and says, "Oh, I left the oven on," but I've just maybe. Oh. Yeah, it's recording. Okay, so volume during wave 4. So you usually, remember, if we're talking about a bullish trend, yeah, you need a catalyst or something to start that pullback, that bearish move down, yeah? And so usually you get some really high volume distribution days to start that, like here, okay? So again, so we've not had a one-day wonder, okay? And then the following days, okay, so the first green volume day wasn't accumulation because it wasn't higher volume than the previous day. And then the volume starts to peter. We get a small accumulation day there, but it fizzles out. The volume starts to pull back down. We get another accumulation day, but it's lower average daily volume. So, you know, people are trying to push it back up, but it ain't working. You know, people want to take profit. Then you get that sort of middle section where the volume starts to drop off again. Then you get a distribution day. And then you get 3 distribution days on the top. So the momentum's starting to build as the profit is being taken and you're going down. And then you see there's a big spike. But overall, can you see from the beginning of the wave 4, the volume is still dropping off. Yeah. It's not like on the wave 3 starting to pick back up again at the end. The average volume for the day is dropping off. So it's not a sell-off, it's profit taking because there's no big, massive volume spike. So that, like there was that started the wave 4 profit pullback. Right, so this is that end of the wave 4 on the left here. So this is the volume during the 5th wave. Now this is important because this is the wave that we're trading, okay? Okay, so the bit on the ellipse there is that last section of the wave 4, okay? So then on the 5th wave move, well, potentially the 5th wave move at this stage, we found the bottom. We get higher highs and higher lows, but look at the volume, it's contracting. So we're forming a foundation, if you like, a support level. So we've not got any momentum there, price action wise, because the volume bar is green, we're getting higher highs and higher lows, but it's with less volume. So there is some appetite to buy there, but the volume's dropping every day. So we're at that stage, this is why we don't go aggressive into a 5th wave move until we start to pick up the volume. Then we get a big accumulation day, okay? So this is the day it triggered, actually. This was KSS. I'm just reading my notes there because I put this together. I'm still suffering from jet lag. So this was the trigger day. Okay, massive accumulation day there. So we did get that contraction in volume with higher highs, higher lows, and then the market just gave in. Okay, it just gave in and said, right, okay, we're resuming the main bullish trend and we're going up. Yeah. See, now then look what happens. We get really flat range bound volume, okay, which happens sometimes because when you're entering a 5th wave move, you're pulling away from a previous profit-taking pullback, if you like. You've had the big move up, and then it just sort of consolidates for a while, okay? Because you don't always get it right, okay? So even if I look for a 6-4 moving average high entry, and I'm looking at previous price action, it's a zone. It's not a price level. When people talk about price levels as support resistance, they're full of crap, okay? Because it's a zone. Nobody makes a decision at $185.19, do they? Okay? They'll make a decision between $184 and $185.50 or something like that. So you can't say it's a price level. So when it gets to a certain point and you get it slightly wrong, okay, or the market is undecided at that stage, we get that flat volume. So we get this exchange of stocks with no real price moving, okay? Then we start to increase in volume. We do get a distribution day, but the day after, that proves that was a one-day wonder because we get increased volume to the upside. We get an accumulation day straight after distribution day. So we rejected that move lower, not interested. Then we get this action where we get in these sets of accumulation days with lower volume. Remember, I think right at the beginning, I don't know whether I mentioned it, that the 5th wave is not as sexy as the 3rd wave, okay? The volume isn't as good, the price action, the movement isn't good, but because all the other rules and observations have been met, it's more likely to go. It's just not going to go as fast as you want it to do, but it's more likely to happen. And you get this constant sort of days. So we're just starting to move, we're in profit, we're getting those accumulation days, and then we get literally 3 accumulation days on the trot with volume increasing every time. So now the momentum's starting to build, going towards our target. We get a one-day wonder distribution day again, but a profit taking. It's natural, okay? But it wasn't followed on. The next day was a red day, but it didn't follow on. And then we got some really big accumulation days driving into that sort of 5th wave target. When you get that, you've got to think, I'm going to start getting out now, especially if you know your target zone, because at some stage that's going to peter off again. Okay, so Trade management now. So we're going to talk about that fifth wave move, but I've just gone slightly right there. You'll see on the right, that big green volume was at the end of that last slide. Now we've gone slightly right again. So we can talk about the trade management just from a volume perspective, okay? So as I said before, we triggered on a high accumulation day. Yeah, so we're in it to win it. Okay, we're in it now. You've got no choice. You've stepped over the start line. So you've got to start managing the trade now. And this is just from a purely sort of volume sort of thing. So as I said before, we get that lull in fighting, if you like, where we get just getting the swapping of those shares. But then we get that sort of increase in average daily volume, getting accumulation days, starting to build momentum now. And at this point, you think, okay, I'm going to go break even. So you stop to break even because you're getting those continuation of those accumulation days. So you're increasing that volume. So the momentum's moving away from your entry. So you should feel safe to bring your trading stop to break even, risk-free. You know, a lot of the times, your main priority is to get risk-free, especially if you've got 23 trades open. Okay, 23% on risk of your $1 million account. You're not going to go for a pee. You're going to sit in front of the computer all day, aren't you? And you want to make it risk-free as soon as you can, because otherwise, you know, your wife says, "Can we go out?" No. Do you want to come to eat? No. You just got to make sure it's risk-free. So then we get that first sign that we might be running out of juice. We get a distribution day, but it isn't followed on. But you've got to have that in your back of your mind thinking, that momentum seems to have slowed down a little bit here. I'm risk-free. Is there opportunity now to lock in some profits? And we'll talk about that with price action. But the idea is now is you've seen a distribution day. It was a one-day wonder, so don't worry about it too much. But keep in your mind, if you get increased volume to the downside the following day, you're going to get a pullback against that fifth wave move. Do you really want to be in it is the question you should be asking yourself, okay? And the answer will be different for everybody. You might have had a really good month and you think, you know what, I'll take the profit, I'll walk away. I won't look at it again just in case it goes back up, but I'm out. If you haven't had such a good month and you're risk-free, you might think, you know what, I'll let that run. I need a win here. I'm risk-free. I'm not risking anything, but I'll let it run. And in this case, it did go on and hit the target level. So with those big accumulation days and that really big day, it hit the target on that day. Okay, that's your first opportunity to take profit. Okay, I don't usually do it straight away because sometimes it can push through that target zone and it can keep going and form a new wave 3. So then the following day, you get a bit of a sell-off, but it's less than half the volume of when it hit the target. So there's those people that got scared and it hit the target, they've taken the profit. There's a lot of people like me with big balls that want to get it going, keep it going, okay? If there's a big volume day following that day, even my balls aren't big enough, I'd get out, okay? But it wasn't, it was less than half. So you've got to think, okay, there might be some more opportunity here. Look at how the market is reacting, how the behavior is. The volume's quite low. I'm going to let it ride, but I'm going to adjust my trading stop. I'm going to lock in, I think that was, when it hit target, it was about 1.8% profit on the account balance. I'd have probably adjusted my stop to around 1%. So I was 100% times risk in profit. So I'm feeling good. Then the volume starts to really drop. So when you get at a fifth wave target level, these are quite prominent fib levels in the trend, and it takes a lot of momentum to push through those, and it does happen, but there's always a lull. There's always some indecision. Everybody's waiting for the first person to put a big lump of shares on and drive the price up again, you know. So there's that lull. Then you get an accumulation day. So you get really low volume on that there just before that ellipse. Then you get a good accumulation day. Another opportunity, that's when it hit the target again, to get out. The following day, you've got a distribution day. More volume than the previous day to the downside. You get out, okay? Because there's only one thing that's going to happen. It's going to keep going down. As you can see, the next three candles, all lower lows and lower highs. Even though it's lower volume, so it might have been a slight pullback, this is your second or third opportunity to take your profit, and it, you know, 3 times is a charm. And if it doesn't push through there, you just got to take your profit. And so it's just understanding how that volume and that behavior is to help make your decisions. So that's volume. Now we've got to do the price action, and then we've got to put it all together. So we're going to talk about corrective price action, support and resistance zones, highs, lows, pivots and trends, specific price action. So what I mean by that is candlestick patterns, because they are a really good indication of how the market is behaving. And then we'll talk about wide range, rejection and contraction. Now, these are terms that I use, okay? This is now a textbook. This is what I, you know, describe things as. So, right. Support and resistance zones. Now, we're going to talk about this afternoon on how to draw them. But at this moment in time, what I've done is just put them on there just to highlight what a support and resistance zone looks like. Remember, we don't talk about price levels. They may be pretty close, but they're not all the same rejection points, are they? Okay. So at this stage, we've had some indecision dojis that have rejected those lows there, and they've formed a zone. Now that zone, as you can see here, I've drawn from the lowest point of the left candle on the wick, and I've taken it up to the bodies of the others. So that gives me a zone rather than a price point, because it was rejected, but it closed at those levels. So that gives me a zone, okay? We test that zone again, and it doesn't push through. So this zone, this decision area, if you like, this decision point, nobody wants to push it down at the moment. So you've got to think this is a price in which institutional traders see value, and they don't want to start selling off and selling big lumps of shares. Okay, so this time we've pushed through. We've come back up to test that previous support zone, and it won't go above it. Okay, so now this is resistance, but it's forming a corridor, if you like, a zone in which institutional traders make a decision. Yeah, and that's important. This is a daily time frame. So we need, you know, while we are around this price, we just need to keep extending that right, because this is a point in which institutional traders make a decision. Okay, I'm not saying it's support or a resistance zone, it's a decision zone. And you've got to be careful. You don't want to be entering a trade in there, do you? Because it'll just kick you out. Then we push back down and we get a rejection, another point. At this stage, it's not a zone, okay? But at this stage, when it initially has that rejection, we can draw that zone in. So then when you see to the right, it pushes through. Oops, let's go back. Let me use the mouse. So we've now got this zone here, the second point in which it's rejected. Now, a few days later, it comes back down and tests it. Look at the price action when it drives through that zone. That's the short. That's a good short, okay? You know, it's like it's acted as support twice, but you know what? Institutional traders say, no, I need to sell. And once it pushes through, it's like I say, I can't remember what the movie is now. They sort of go through this like mud or something like that. But when they push through it, they drop to the floor. And that's like selling. They're trying to push through a support zone. Nobody you know, wants to buy, and these guys wants to sell. So the broker put the price down a little bit. No one still wants to buy. And all of a sudden, breakthrough, bang, 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 bang. And sometimes a broker can't keep up. It just, you know, just keeps putting the price down and people buying because people will see value in that. And that move there is, I mean, this one as well here. I wouldn't have gone, let me just use it because we've got people online there. This one here, again, it broke through that support level and it had a big move down over a few days there. That was a good trade. And then when it came back up and tested that previous zone as resistance and bounced back off, not a great trade. All of a sudden you're starting to see those support and resistance zones formed, and they're critical, they're decision points. So do you see, this is why we use charts, it's all visual, okay? There's no formulas or anything like that. When we talked about volume, it's about visual. So there's a few things I want to talk about here, then we'll see examples. So price barely making higher highs or higher lows. It's running out of juice, yeah? Highs and lows forming strong chart patterns. We'll look at a few of those. Sort of long trend channels with small pullbacks, like a high growth stock like Visa, for example, and this just recently. But it's got like a 10-year channel that's really tight with very small pullbacks. You need to identify those. So you've got larger candle wicks while price is making new highs and lows. And again, we'll talk about and do some examples then. And short-term reversal and swing points. So let's go through these. So forget volume for now. We're on price action. We'll put them all together. So you can see here we're getting higher highs, higher lows, okay? Then we get that first candle where we get, some people call it an inside bar. It doesn't matter what it is. It didn't get a higher high, higher low. It got a lower high and a lower low. At that point, there's something going off, yeah? We don't know what it is yet until we get confirmation the next day. Then we get some higher highs and higher lows. But this time, we get two candles without a higher high and a higher low. So we've gone from one sort of indecision day to two. The juice is starting to run out, okay? And then we get very slightly higher highs and higher lows. So, you know, we've got warning signs early on in this move. So if this is a fifth wave move, for example, we've got early warning signs so we can make it risk-free and start managing it. And then that warning sign gets bigger. We've got two candles, and then we get then those slightly higher highs and higher lows. So we're running out of juice. We're on a bike, you're 50 years old, you got the wrong gear, you get to the top of the wheel, you just can't make it. Yeah, and that's how the price action works. And that's how you've got to recognize it, not just for trade management, but also, you know, if this is a wave 4 pullback against a bearish trend, this is a good sign that you should be looking at this right now. Have I isolated the wave count right? This looks like a wave 4. This is running out of juice. It's going to return to the main bearish trend. And it's the same to the downside. Look at the difference though. We saw the difference on volume. You know, with the bigger volume distribution days, look at the price action on the down days there. Lower lows, lower highs, but eventually we get slightly lower lows and lower highs. It's running out of juice. There's less people that want to sell. But it's a lot more powerful going down than it is going up. Right. Charts are ugly. Sometimes you don't see head and shoulders patterns, and that's fine, okay? I've drawn it in for you. Look at the right shoulder there, slightly higher than the left shoulder, okay? This is something to watch out for. You see the pivot underneath the head on the really long red candle, okay? That low was rejected, and then it went back up again. So that's what we call the pivot point. So if you get a head and shoulders pattern like this with a slightly higher right shoulder, you're looking for a short, okay? You're looking for a short below that pivot of that really big red candle. Now, not everybody uses these, but I wanted to show you some sort of basic examples that, you know, if you're all day like me looking at a chart, you'll start to see these and draw them in. Just draw them in. Because even if we're at this point, we've had this pullback and it starts to come back up again here, and you've only drawn the left shoulder and the head, that's fine. But when we start to see that resistance level form on that right shoulder, and it starts to pull away from there, draw it in, and you should then recognize this is head and shoulders with potential downside.
Do you think that because the right side is higher, that's what you look for a short?
Yeah.
So
because
the right side is lower than you look for a bounce up. In
theory, not all the case. What I'm trying to do is give you a perfect example of a short. Now, you look at the left shoulder as well. It's only a very small, there's only a few days in there. But when you look at the right shoulder, it's a slightly higher resistance level, but it's about 5, 6, 7, 8 days. So that then gives you the inclination that nobody really wants to push it any higher. But I'm not going to go short yet because I need to see it go below that A pivot for that big red candle. Because at that point, institutional traders saw value and bought. So I don't want to get involved in any short until it's below there. Okay, this is head and shoulders. Low. Okay, so this is the opposite way around in that your right shoulder, so your head is at the low, at the bottom. Your left shoulder is slightly higher, forms a great double bottom there, by the way. But then your right shoulder is lower than your left shoulder, so the other way around, okay? And then you're looking to go long above a pivot of your choice in this case, because the price action is pretty crap. For me, the long is above this pivot here because this is a really big resistance level. 1, 2, 3, 4, 5, 6, 7, 8 days, yeah? So if you go above that pivot there, you're pretty safe.
So you could have a shoulder pattern that is lower than the shoulder?
This is inverted. Yeah, it's inverted. Yeah, it's inverted. Yeah. Yeah, the head's down at the bottom. Look what wave count it is. Wave 4. Okay? This is freaky stuff, I'm telling you now. Okay, so you've gone from a wave 3. Your wave 4 forms the left shoulder and the head. Okay? Now the momentum starts to come up. Your price action is pretty good moving away from that wave 4 low. Fantastic. Okay? This is going to be some freaky stuff for them because when we get to the end, the volume chart was the same one and we put it all together and you'll see what I mean. So we come up, we come back down, but we get a higher support level than the wave 4. So no one's interested in pushing it any lower. And so when it comes back up again above this level, that's the time to get in your 5th wave trade. Okay? As long as your risk reward's okay. Okay. Highs, lows forming strong chart patterns. Double top. Right. Now a double top is not, it doesn't have to be the exact same price. Okay, $185.19. If it's $185.18, it's not a double top. That's crap. 3% of the price. Okay? So if you've got a high on that left of that P pivot there at a certain price, the other high is slightly lower. Okay? For me, I just draw a 3% zone, put it across. If it's in there, it's a double top. Yeah, pretty simple. Depending on the price. $2,000 price is different to a $20 price.
I heard there was a rule if you come and get for support, I think more than 3 times supposed to break the 4th time or something. Is there such a rule? I've seen it get 20 times.
Yeah, no, I don't take it. Sometimes for me, if it can't push through 3 times, I get out because it could then be range bound. I'm thinking, right, what could happen? I could get lucky, it could push on the fourth time, but it could be there for 6 months, range bound. Yeah, you just want to get out. Yeah, sometimes it's twice, depends on the volume, obviously. You're using the volume as well. Yeah. So we see the double top there, the double top high. The entry is below the lowest C pivot here, okay? You see how the momentum initially pushes away from that double top, but you want to make sure you get below this C pivot here, because that's, you know, and the previous C pivot rarely forms a double bottom. So that's a zone of support that you want to make sure you're below before you go low. Now, the wave count C, you can see a really short-term fifth wave move up to cause that second top, to cause the double top. But then when we talk about trend reversals, and this is a different lesson for next year, what we look for is a break initially of the wave four of the previous bullish trend. And you can see that pulls down below that bullish trend wave four. So we've got the double top, we've got a potential trend reversal to the downside. If you're really aggressive, you go short below the wave four. But because you've got a double top and you've got a pivot, conservative English guy, you go below that pivot and you can see it just went all the way down there and formed a new trend. We've got a 1, 2, 3, 4, and we've got a fifth wave move to the short. And that's how the market cycle goes.
When you trade the 50, you trade the 50 to the downside as well.
Yeah, up or down.
You're saying that's the longest. The third's the longest.
The third's the longest, but it's the hardest to get in because you don't know when it's going to end. Because you haven't got all of those rules and observations hit first. You're in it to win it. It becomes a third. Yeah, if it breaks through, you're really in it to win it then. And it happens. No, it's always slightly above. It's about 120 to 140%. Yeah. Yeah. Okay, double bottom low. It's an ugly chart, but it's still tradable. Okay. The reason I chose some of these that are not quite perfect is because not all charts are perfect. They still reflect the market sentiment, but you've got to sort of step back and look. Sometimes you sort of stare so you can see the pattern. No chart's perfect. Okay. So we've got a nice, you can't see it, it's on the left. On your TV screen, you can see it on the computer, but you've literally got, you see the big wick where the C pivot is there. You've got a similar hammer on the left here. It's on the computer, it's not on the TV screen. And they're almost at the same level. So that's a really good double bottom. Where do you go long, do you think? Past the fifth wave high there, yeah. Okay, you want to make sure it's away from that zone. And again, this is what happens after a fifth wave. You get a corrective period, and we're going to do that this afternoon. But you want to make sure if you're going to do a trend reversal, you're out of that corrective period. So if you've got a double bottom pattern after a fifth wave, you've got a correction. See, that was a fifth wave high, but it refused to go, and it was all range bound and corrective. It formed a double bottom. And then it pushed higher than the previous wave 5 high, you're going to go long, okay? And that's a third wave. That's how you trade the third wave as well. And then we've just pulled back on a wave 4. You know, some people, some institutions will have a desk, and the guy just trades 5 stocks. That's it. And the guy next to him trades another 5 stocks. And the guy next to him trades another 5 stocks. And all he's doing is looking for those patterns and multiple time frames. And it's something I teach in the elite training course that's already up on the website. It's those multiple time frames, so they will become intimate with those stocks. They'll know what they're doing. They know what the wave count is on a weekly, on a daily, on a 60, and they will trade those stocks. Not every day, but you know those 5 stocks will keep them busy on multiple time frames, especially if you're going to trade the fifth. Okay, so long trend channels with small pullback. So we're going to talk about how to draw the trend channels this afternoon. But in essence, these are not linear, okay? these channels are drawn by institutional traders. I can guarantee it. Okay. Once a trend is formed, it will respect a channel. It could be a wide channel, it could be a low channel, a very narrow channel. This is a narrow channel, and you'll notice. I'll go into drawing this afternoon, but you see how prominent that middle, that center line of that channel is there, support and resistance wise, really, really strong. And that's the important part of the channel. You get the hits, the highs and the lows, you get the trend lines, but that center line is really, really important because it bounces off it, okay? So you look at that on a longer term view, you know, the wave 4, you know, it didn't fail because we got higher highs on the channel and it was going up, but that was we call it a slow boat to China, okay? That was a long fifth wave. Really difficult to trade those off a daily time frame.
How long is that?
Each candle's a day. Yeah. yeah, that's Visa, yeah. Now, we go down to the 60-minute time frame within that channel and we look for potential trades. Okay, little glimpse of multiple time frame strategy there. But what I wanted to show you is sometimes with those tight channels on Visa on the daily, you've recognized it's a really strong growth stock and it's going up. There's good price action, there's good volume, but you don't really get a wave 4 pullback. But you look at other chart patterns as well. Look at that double bottom there where we get the wave 1, the wave 2 on the 60-minute time frame. You go long when it goes above the wave 1 high and you trade it to the center line of the channel. If that was a wave 4 pullback, even better, okay? But you're looking for those patterns on multiple time frames. Got another double bottom there. So it pulls back, it bounces off the center line of the channel, forms initial support on that left P pivot, comes down, forms a double bottom again on that P pivot. You're going to go above the top P pivot and go long, and you're going to trade it to the center line of the channel. Okay? Okay, short-term reversal swing pivot points. So when we're trading the fifth wave, we need to see how the price action responds around the third wave first and how it responds around the fourth wave, because sometimes we may not gain a trade depending on how that price action forms. So what I want to talk about is clusters, okay? Now, for me, when we get that wave 3 high there, there's a big, that's like an indecision doji, it's a big wick, okay? But then we get a cluster of candles all at that same level. That's not a good sign, okay? I'll show you a really good one in a minute. When we get that cluster, there's total indecision in the market. Some people want to sell, some people want to buy, but it's formed a range at the wave 3 level. It's not gone on, hit a ceiling and come back down again. There's less appetite to take profit, but there's less appetite to actually push it higher. So we've got this cluster. And when you get a cluster, it's not a really good sign. Even if it pulls back on a wave 4, it's going to be a strong fifth wave move. So and again, at the wave 4, we've got another cluster of candles. Now, not all the time, but usually when you get a wave 3 occur and we get a cluster, and you get a wave 4 occur and we get a cluster, that's going to go range bound. So you may get in a fifth wave move, but it might not reach target. So when you get that cluster, if you like, it's like a build-up of decision at a certain price. Nobody wants to go up, nobody wants to go down. And if you get that at the wave 3 high and at the wave 4 low, when it tries to move back up through that cluster zone on the wave 3, it's going to really, really struggle. Do you want to get in a trade like that? Yeah. Yeah. Earnings, most likely. There was a catalyst for that.
Oh, there must be new.
Yeah. Yeah.
Yeah.
No. that would have been a catalyst in earnings. So that that big drop down, where yeah. And again, no. Remember, a chart, the technical chart is the representation of the market sentiment and reactions. So there was a news event or an earnings or something like that that forced that to go down. But actually then when it formed the wave 4, there was another cluster. So there was some profit taking, but you know what? People may be still interested. That's quite good value. But the cluster at the top, the cluster at the bottom, you've got to walk away from something like that.
Initial bounce, and then there's the next day was pretty much flat. A little bit down to the downside, then it just dropped back down again and broke below the previous support level. Right?
Yeah, yeah. But there was big rejections. There was big wicks now this wave 4.
Yeah.
So, you know, there was some profit taking, but nobody wanted to drive the price any lower. If you see clusters, it's ugly. Yeah. You don't take this one home to meet your mother. Okay. So that's bad. Yeah, that's real bad. He's ugly. Okay. Now, this isn't the prettiest, but she's a keeper, okay?
Yeah.
So we get the wave 3 low, which rejected really well. We get a wave 4 pullback. We've got those lower highs. You know, that we got those, it's just creeping up. It's running out of juice. And then when it runs out of juice, it comes back down nicely. There's no cluster. There's a decision straight away in the market. So it's a keeper. Yeah? Yeah.
He's in the center of that chart. Same kind of thing happened as the previous chart. Oh, and then he had a slightly lower day.
Yeah. That's a sign that it's running out of juice. Yeah.
But then he didn't follow through and come down.
That's right. You see this here? So the wave 3 was a big rejection, but that was a one-day wonder. It did then have 2 red days, but then we had a squeeze day, that green day. So the big red bar in the rectangle on the left there, it closed at a certain low. And then the next day, it gapped up and then remained green. But it was, price action was contraction. We call that a bullish harami. We're going to go through that in a minute. But that's a really good sign it's then going to go up.
So if you was due that center channel, that green one, that's followed by the red, you know what I'm talking about?
Yeah. Yeah, yeah.
If you had dropped down below the low of the previous day, that's what right?
Well, no, because I'm looking at the 6-4 moving average low. It's all the way down here.
Oh,
There's no entry. There's no entry. What you're looking for is that continuation and the exhaustion, and then the move down, and then you go low below the 6-4 moving average low. That's why I put them a 6-4 moving average low on there, because it's advanced. It's 4 days in advance. That's why at this point here, it's 6-4 moving average. Okay, so it takes the average of the last 6 days, of the lows of the last 6 days, and then it skews it over to the right 4 days in advance. So it's ultra conservative, yeah. But that's when you get those big moves up there, and it's sort of, because it's advanced, it takes time for it to come back up again. So you wouldn't go low. Yeah. You'd have your stop limit order in. So you'd have your stop limit order in around about for the next day. It's got to be below the low of this previous day. So it's about here. So yeah, so it's gapped down. It's moved back up to the high, and it'll take your stop limit order in. Because you put I don't know what the price was on this, you would have put plus or minus 10 or 15 cents, and it'll take it in. Or if you're actually active and you sat there and it blips up and rejects those high, you go short.
If you like right there when it opens lower below the line,
yeah. No, because your risk to reward wouldn't have been good enough. When I say it in the trade room, you've got to wait. You've got a figure in mind. When you worked out your entry strategy. You put your entry line, your green line. You did your risk to reward. Okay. So and then say your risk to reward's 1 to 2 into the target zone. You can then, if you're doing and you're in my pre-market prep show, we look at these and say, right, this is gapping down, okay? Where is the lowest point I can sell this and still get a risk reward of 1.6? And you put that on your chart. So you can even, before the market opens, put that price in and change your order to that price. So usually with a gap down, it'll gap down, you get a blip up, and it'll go down again. So that, looking at that price action for your orders, or even your open trades, before the market's extremely important. Because if you're going to get that gap, you've still got a minimum risk to reward in your head. You're going to put it on your chart. So even though you've got the gap down, you'll say, right, if it blips up to this price, I can still get in. Well, it's got to be past the previous day's low, but if it doesn't quite reach that, you don't get in, it comes back down again, you're going to really be annoyed. Yeah, for a short. Yeah, you're going to be below the previous day's low. It didn't quite make it. So when you're doing your risk to reward, you're going to put your price of your sort of ultimate low price before it goes beyond your 1 to 1.6 to target. Now, that you're going to have to do that pre-market because you need to know what your original risk to reward is. Well, the move up would have probably worked out. Because you see where your wave 4 is, that's your stop. Your entry was there. That's a 1 to 2 just to the wave 3. Add 40% on that. That's like a 1 to 2.5 or something. So in reality, the 1 to 1.6 is probably roughly where it opened, and you can make that decision. Yeah. Yeah. Oh yeah, yeah. 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 And that was a good trade. That's good. Yeah. So we've got to keep to the core patterns, and that will help sort of trading the fifth. So the reason I've chosen these patterns, because these occur a lot when you're trading the fifth. There's lots of other patterns, and you get books and books and books with all these different patterns. But you just need to keep to these specific ones that occur a lot of times. Almost there. Almost there. Candlestick patterns now. So again, we're going to keep those core patterns. Okay, so the first one, that was a big, nice rejection of the wave 4. So that's a hammer, yeah? It looks like a hammer, okay? So that, or a shooting star. Some people call it shooting star. I call it hammer. I'm an engineer. If it don't work, hit it. Yeah, so I call it a hammer. So these long wicks are a great sort of rejection of that low on a wave 4. So if you've got a wave 4 coming down against the main bullish trend, and you get a big long wick like that, that's a good sign that sort of profit taking is over. Yeah. You need the confirmation day.
So what happened? There was no buyers.
So there was people taking profit. Okay. But all of a sudden now, people are prepared to sell at those prices. Okay. But then all of a sudden, institutional traders see value in that price. So there's sort of small bits of volume pushing it down, pushing it down, pushing it down. But then when it gets to that low, they think, do you know what? That's a really good value. I'll buy 500,000 shares.
That usually has a super fast time.
It does. We can't react to that. We're waiting for that to happen, and then a continuation day the following day. Yeah. Bang it in. Straight out. Yeah, yeah. Yeah. But as retail traders, we are waiting for that to happen, but then we're waiting for a confirmation day. You see the candle afterwards, it's a bullish engulfing, okay? So it gaps slightly lower than the previous day's close, but no one's interested and it goes up.
So you enter the 30?
No. 6 moving average high, previous price action. All you're doing is identifying that wave 4 low. You're not going to make any decisions yet. You want to make sure institutional traders are going the right frigging way before you get in. The people that get stopped out and lose money are the ones that make a really rash decision there. even that confirmation day, it's not brilliant, okay? Wait for that day to finish. Where's your 6-4 moving average high? What's your risk to reward? Blah, 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 okay? Don't make any instant decisions. So that's a rejected price level. Piercing line. So you've got two big candles. The first red candle closes right at the low, okay? So that's a big bearish day, yeah? Then the next day, the price gaps down. So there's some pre-market action still pushing the price down. But as soon as the market opens, those that weren't doing the pre-market stuff see value. What do? They bang a load of orders in and it pushes it up, but it doesn't quite meet the high of the previous day. That's why it's called a piercing line. So the close pierces the body of the previous day. It's just an indication there's a potential wave 4 forming there. So these patterns, yeah, it's bouncing back up.
The one on the left passes the whole, then it's just positive move, right?
Most likely, yeah, because we get a higher high, higher low the next day, and then we get a gap up as you see the next day. That's a bullish sign. That's a sign that the wave 4 is over. So that's a good way of identifying a reversal in that profit-taking pullback. Now, this is obviously the same going the other way, going down as well.
Do you play the last half an hour, or do you don't play
That's
that?
10 p.m. my time. I'm drinking whiskey on my deck, watching the sun go down. I don't trade that last half an hour. Yeah, yeah.
And I had 10 contracts in. I had short at 57, 58, and I had my target right above the previous support level.
You're right.
So I saw at 54, I saw at 51. I'm telling you, it's 12:59. He went from at 12:50 he went from 58 to 64.
Yeah.
Did you see that? I'm like, I wasn't even scared. I was fucking like crying. Relax. I swear you at 11. I know I'm correct. 159, 48. I mean, 12 seconds left for the market closes. We went to 64. Boom, 50. I mean, 14-point drop on that.
Yeah.
I didn't even see it. I just saw my orders before. Built everything. Like all my orders got built. And I went back to 58 within 10 seconds. He just said, 12-point move in the S&P.
That's a lot.
That's like 20-point move.
12-point move S&P is a lot. Yeah, yeah, yeah.
There's a lot of money.
Yeah.
Boom, boom.
Yeah. No, I don't trade. Yeah. No, the last some traders. Yeah, some traders trade that last hour, the witching hour. But for me, I live in Europe, so I do most of my activity in the first 3 or 4 hours of the day.
That's why I was getting alerts from you.
Well, no, the thing is, with the day trade, you won't get alerts. Sometimes with our day trading service, you will get alerts in the first hour or so. But if some of them don't work out, guys, we're not doing it. It's not trending. It needs to trend.
A lot of professional traders say that you shouldn't play Fridays. Don't play the Fridays.
Yeah.
Don't play the last hour.
No. Yeah. If I don't see any good orders in the first few hours, we don't put any more signals out, because then you've got the European close. So all the European traders in London and everything, they're going home. We're on the tube. See, volume's going to drop for a while. So unless you get a good entry on a day trade in the first few hours, I'll close down.
Are you playing the European market or the FTSE or anything like that?
I've got European shares in my portfolio, but I don't, no, because not enough volume. Not enough volume. US shares are more sexy.
Yeah.
They move. Yeah. Okay, bullish engulfing. That's pretty obvious, isn't it, really? Yeah. You're in out. Yeah. Okay. But you see those previous 3 candles, those indecision dojis, that's a sign that bearish move is running out of juice. Okay. You then get a little bit of rejection. You get a 50% retracement on that larger red candle. So it's rejected the lows, but only 50%. You're unsure. The next day, it gaps down, not interested, shoots up, engulfs the body of the next day. Good bullish move. Okay. And you'll see those at wave 4s as well. And then conversely, bearish engulfing. Okay. So you get a big move up, you get a gap up on a green. Next day it gaps up, not interested, sell off, take profit. Boom. Yeah. And so you get the follow through. Yeah. So if you're managing a trade and you get that, you get out. Okay, because that's the sign it's going to go and keep going.
Usually this 5-way pattern, I mean, what time span are you looking at to create the pattern?
It doesn't matter. You can do it a day on a 3-minute chart.
You could actually do that on a day.
Yeah, we do it on futures.
But I can't do it on the 1-minute chart on the DS, right?
Yeah.
You can still, I see that happen.
Yeah. And it does it in real time. Yeah, you can do it. Yeah. You'll see a trend form during the day on ES, on futures. You just need to measure that trend. So you go down to 5 minutes, 3 minutes, 1 minute. You can trade that if you want. I mean, 1 minute's pretty tough.
Most of the time it just goes up, it comes down, then it comes back up. It's like it kind of in the shoulder pattern, but it goes up.
Yeah.
It hits the peak around 11 o'clock, sells up to about 12:30, and then it comes back up a little bit at the end and closes.
If it's a trending day on a 5 or 3 minutes, you'll be able to trade a 5th wave on the futures. Yeah. Okay, so next one. This is a bullish harami. Okay? Harami. Japanese. It's a pregnant lady, yeah, or a fat British man, yeah? Okay? I'm a bullish harami. Unless I'm doing a headstand, I'm a bearish harami, okay? So what you've got is, you've got this big bearish move, closes near the low. The next day, during pre-market, people see value, it gaps up, but there's usually less volume, and we'll go through that in a minute. But you get a green day, but it's like a pregnant lady. And then that's an initial bullish signal. You need confirmation days. So the next day you get a higher high, higher low. The next day you get a higher high, higher low. Looking like a good wave 4 here. So you've got potential trade. Morning Star. I love these. Okay, I love these. This is an island on its own. This is a day in which no one was interested, because the previous day was a bearish day. It gapped down. There was an indecision. The next day it gapped up. It's all left on its own. You know, no one was interested. That's a really great sign.
After it came down and tested support and then shot back up, right?
Yeah. It is. Yeah.
All the time at 6:30 in the morning.
Yeah, that is a really, really good move. Yeah. Really, really good move.
Do you play reversal, the first half an hour reversal? Yeah,
I'm too busy.
I know, but downward cycle.
Yeah.
Usually on the other side gets overbought right at 7 o'clock and it reverses for the first.
Yeah.
That's free money. I think that's like most of the time that's just like free money.
So now we're going to combine them with volume. Okay. So, bit of a test. What's the candlestick pattern there? The wave 4. It's a bullish harami. It's a pregnant lady. No. The wick is slightly longer. The hammer is right at the head. You know, okay. Some poor engineers, when they build a hammer, have a little bit sticking out the top. Okay. A proper engineer, it's flush. Yeah. You got the hammer head on top. You got the best swing. You got the best momentum, and it will go. So this is a pregnant lady. It's a bullish harami. But also, when you're reading that, you're seeing massive rejection as well, because you've got a big wick. Look at the volume. It's a rejection on high volume, a bullish harami. We've got a lot of ducks on the row here. This is a good wave for. No. Look at the green volume day. It's an accumulation day on the day we get the rejection and the formation of the pregnant bit of the pregnant. On lower volume. Yeah. And then we start to get accumulation days. So we get the first green day with a good close near the high. The next day, we get a higher high, higher low with higher volume.
Well, it's interesting how the move wasn't that big, that much volume, and then at the end, you're just jumping up on low volume. That means there was not that many sellers.
No. But what you know, the sign is there that we are moving away. We found support of that wave 4. So we are gathering momentum.
I just think the fact that the volume wasn't as big at the end and the moves were much higher to the upside.
Yeah.
That tells you way more buyers.
Yeah. There's some good value there. But so that's combining volume now, accumulation days, the rejection on high volume with the price action. So really, really, really good. The next one, we've got a piercing line. Now, this is very common. So usually your green line on a wave 4, your green candle is lower than the previous day's red candle. That is very, very common. This is why we don't make instant decisions, yeah? We look for continuation the following day, which is an accumulation day. We get higher high, higher low. This is the right-hand candle, and we get an accumulation in volume. So usually, when we form a wave 4 on a piercing line, that green day that rejects is usually lower volume, okay? If it's higher volume, it's usually a bullish engulfing, yeah?
Can I ask something?
Yeah.
Some people think that on news days, some people love to trade news days, some people say stay away.
Stay away.
Stay away.
Yeah.
That's most professional.
Take the day off, go to the beach, drink a margarita. Yeah. Yeah. Let people have the fun. I want, it's a business, yeah? Consistent. No. I want to go to the beach. I want to drink a mojito, get on my paddle board, come back the next day. The market's still open the next day, you know? It's amazing. Yeah. That's right.
I was young then. I was just young, I get my head handed to me in 10 minutes.
Okay, so the next one. So we talked about the piercing line. So we talked about the piercing line before, that the green candle had lower volume. So now when the green candle has bigger volume, we get a bullish engulfing because it just keeps going. So you can see there, we're getting those distribution days into that wave 4 low. So we're getting the higher volume, but look at the rejection on that bullish engulfing day. That was a massive accumulation day. So we've got that accumulation day. We've got the bullish engulfing. Might be a one-day wonder. The next day we get a higher high, higher low with a lower volume. That is normal. But what we look for then is increased volume and increased price action following from that. Okay, so that's important. So these are patterns and volumes that we see at those wave 4 lows. Remember, we need to see how that wave 4 behaves so we can get those high probability fifth wave moves. What's that one?
That's a hammer, right?
A bullish harami. An Englishman, yes? Okay, look at the volume of that green candle. It's lower than the previous day's big red candle. That is normal, okay? We're getting a little bit of contraction. We got the gap up, we got a great green candle, but we get lower volume.
Like a much bigger candle, the red one, the volume should be higher.
And that's how the bullish, yeah. But sometimes you'll see the green candle go too high and you get a higher, higher volume. So you might get then that cluster of candles. So we're looking for the perfect setup, okay? We're not looking for clusters, we're looking for a bullish harami, and then usually that volume is slightly lower. Then the market sort of settles, you get the higher high, higher low, and you see on that last green candle slightly increase from that red day on the volume. So we're starting to move away.
Well, what's the longest you ever seen a stock run? Just like remind me, like just running.
CIG in 2013 traded a trend reversal, and it went for, I think I was in it for 4 months.
Every day up?
I traded the, well, no, I traded the wave 1, the 2, the 3, the 4, and the 5.
Just run constantly, like one side, up or down?
Oh, no, you're talking 5 or 6 days because somebody will always take profit. Yeah. But overall, when you put the channel together, you will see a really good move. So that's, you know, but, you know, I've been in a trade for 4 or 5 months on a trend reversal. Hit the wave 5 low. And that one hit the sort of listing price as well. So it's a really strong level. And then I literally traded the 1, the 2, the 3, the 4, the 5, and it was a great trade. And you know, Visa, that's been in a trend for 10 years. So when you look at it from when you step back and look, yeah, it's better than MasterCard. Visa's better than MasterCard. Is it? Oh, right. So to finish off, that behavior sort of combines what we've just discussed. We put the price action, the volume together and identify how that wave 4 behaves. Yeah. So it's that behavior that we're really interested in. Okay. So that is perfect. We've done the first 2 sessions of the morning. It's all been death by PowerPoint, I know. But this afternoon, we've got one more set of PowerPoints. Then we're going to get on the charts and put everything together we've just discussed and look at Apple and Netflix and so let's just stop the recording. Okay, so let me just stop the recording.